All right, we're going to get started in the interest of time to keep people, to make sure people stay on schedule. Good morning, everyone. My name is Philippe Rivera. I am the acting CEO for the Vermont Community Foundation. While we give Dan a little bit of a break, I was saying to Mike, we're giving him a chance to go dip his toes in the lake for a few 2 to 3 months. I think it's going to be. So I am your host today. It's really nice to see many of you on this call. Uh, Before we get rolling, I'm just going to introduce our presenters and acknowledge some of the VCF staff and the board who are on this call. Then I have just a couple words to say by means of introduction. But joining us today, you will see on your screens, and I apologize, I can't see everybody who is on the call, so I'm just going to talk a little bit about who I think is here. Mike Miller, of course, he's the founder and CIO of Crucial Partners. VCF has been working with Mike and his team for, I think, going on 20 years, right, Mike?
Yeah.
They have been an incredible partner for us, and through them, the folks that establish funds at the VCF get access to a really deep pool of institutional knowledge about mission, about investment management, and they get a partner who just keeps a steady eye out on long-term sustainable growth, which is so important to many of the folks we work with. We also have Lawrence Miller, who is a senior advisor for us in the mission investments part of our work. Many of you know Lawrence from a lot of his previous jobs. He is an individual with many, many different talents. He's an entrepreneur. He is the former secretary of the Agency of Commerce and Community Development for Vermont. He's a consultant. He's a former CEO of Danforth Pewter, and as well, he founded Otter Creek Brewing. So thank you, Lawrence, for being here. It's always great to see you. From our board, we have Tim Briglin, who is the chair of our investment committee. I think I also saw Tammy Newmark and, of course, Rod Buck, who are on that board as well. Professionals with a lot of experience behind them. And there may be other members on the call. I apologize again if I can't see you on the screen that's in front of me right now. From our staff, we have Barry Pius, who's our VP for Finance, and Abby Meyer, who's our Director of Investments. We have Stacy Fagan, who is our VP for Philanthropy, and some members of our team, including Martha Trombley Oaks, Elizabeth Marks, Emily Pila Corbett. I saw Emily out there, and Chelsea Lord. I'm not sure if I saw Chelsea, but I believe she's on the call as well. For those of you who might be new to these calls, the purpose of these calls is to give you an update on the investment performance of the funds that we manage. Now, one of the best things about having a fund at the VCF is knowing that your money is going to be managed responsibly with an eye to the future. We have a very talented investment committee. I named some of the folks on that committee that set our investment approach, and then we work with Crucial Partners, Mike and his team, to put that thinking into action. Three primary things we look for in how those investments are managed. We look for reasonable fees. We look for positive social impact wherever possible. And we're going to have a little bit more to say about that when we talk about the core pool that we just launched. And very importantly, we look for long-term performance, the emphasis on long-term performance. Our goal generally with our funds is to preserve the value of those funds so that they can support the causes that you care about in Vermont and beyond over the very long haul, something that is increasingly really important when you consider the scale and the depth of the social challenges that we're facing right now and the ones that we are likely to face moving forward. I can't not say a few words about our Vermont pool, which is our investment sleeve that focuses on mission-aligned investments that directly benefit Vermont. So for those of you who have been with us a while, you know that we have been a leader nationally for community foundations in place-based mission investing for more than 20 years. And we have earned a lot of recognition, again, nationally for projects that are supported by the Vermont pool. These are projects like the Putnam Block in Bennington, the Springfield Co-op, the One Community Arts Center in Burlington, and the Railroad Street Project in St. Jays. These are projects that put people into homes, that breathe new life into local downtowns. And the best thing about them is that in most cases, simply having your fund at the VCF directly makes projects like those possible. So it's a really wonderful aspect of the work that we're always happy to share with the folks who have funds with us. And we'll have a little bit more to say about that later as well. With that, we have a lot of territory to cover, so I'm going to stop talking. I'm going to invite Mike to take us through the latest performance update. I would encourage all of you on the call to use the chat function if you have any questions during the presentation. We are going to leave time at the end of all these presentations for any questions that you might have for Lawrence and for Mike. So Mike, take it away.
Sorry, I'm muting myself. Great. Thank you, Philippe, so much. Good morning, everyone. It's really nice to be with you here today. A really exciting meeting today, I think. And I'm going to be relatively quick talking about the past because we have so much to talk about with regard to the future. And as Philippe said, the core pool. So these are the performance numbers through June 30th for the previous pools. As you see, possible Barry, and we'll talk about that in a bit. And what you can see here, of course, is really strong. First of all, absolute gains. One of the things we try to remember about markets, as you know, is that they're highly unpredictable. I mean, the world is a very complicated place today, and that one of the beauties of this strategy, both past, present, and future, is that it's not dependent on knowing the future with any certainty. Another aspect of this about each pool, especially the long-term and the social responsible pool, have had their own days in the sun. And one of the beauties of the core pools, we'll talk about later, is that it blends the best of both pools together. And here you can see, after a few years of the social responsible pool being the stronger pool because of its heavier index exposure, the long-term pools kind of come back over the last year and taking the lead once again. And long-term, if you look at the 15-year numbers, they've kind of ended up the same. And so, part of the motivation for the core pool is, why don't we try to take the best of everything we've done and put them together into something that's, where the sum 1 + 1 is not 2, but potentially 3. So these are the pools. I'm going to keep moving quickly in the interest of time, and also because we have so many things to talk about today. If I could just make my slide go ahead. Just as a reminder, and this strategy applies to the core pool as well, which I'll come back a little later and talk about some of those details. But just to remind you all, this is a strategically oriented strategy. So as Philippe said, we're very focused on long-term outcomes, and Philippe correctly used the words preserve impact in Vermont and beyond. And if you think about that, that doesn't mean beat the S&P 500 every year, although you want to do that, of course, but it means impact. And we're at very tricky times. I know we've all talked about in many meetings. We'll probably maybe a second talk about that today again. But the strategy is, again, think long term. You ignore securities. In fact, you try to capitalize on the mistakes that short-term investors make every day. But the second point is also really important. We're not trying to predict the future. Frankly, this administration, whatever you feel about them, you can say one thing for sure: they certainly make it challenging to decide what's going to happen next. And so, therefore, really trying to guess that has never been easy or even possible. And this administration only just puts an exclamation point on that. And as I say, speaking of foundation committee or the board review, but speaking of myself, the ignorant person diversifies. So if we don't know about the future, and I consider myself quite ignorant on this point, then we basically try to make sure we have risk that is very well diversified across a lot of different things. And one of saving graces for this year is its diversification, particularly outside the United States. So just to kind of emphasize this point, we are more than a little worried watching the index take off again, led by some of the mega cap stocks. And it's not that we're predicting a crash or saying that these stocks are going to be worth fractions of their current prices. We're not saying that at all. What we are saying, though, is that when prices get very high for things, what you need to think about is the fact that markets are basically saying the future looks fantastic. That's what high prices mean, essentially. Low prices mean the future will be terrible. And so when you're paying high prices, and maybe the future is pretty good, but pretty good is not awesome or amazing. And what happens is stock investors get punished when the future is only pretty good and things are priced for optimism. So we prefer to actually think about things and we like to own pessimism, frankly, because then when things are pretty good or just okay, or even a little below average, you do really well. And I think that's something that gets lost for a lot of investors, is that point. And then the last thing, which is really new, and this is really very much tied to tariffs and the current administration, non-dollar currencies have become an incredibly interesting hedge. So when you own euros or pounds or yen, you're essentially buying insurance against either perceptions of the United States around the world or actual economic outcomes in the United States, et cetera. And we would argue it's not only free hedge, it's a very, very profitable hedge, because the dollar has been, even before this administration took power, grossly overvalued compared to other currencies. So it really is going to fall eventually anyway, long term again. And so we just love this. This is like the gift that keeps on giving. And then just to illustrate what this looks like, so I showed you all these terrific double-digit gains for the last year on the pools, very quickly before. But what I also want to emphasize is how well the pools, the two long-term pools have basically protected capital when things got really ugly. So we picked a moment in time, one of the worst moments in time, at the very bottom, very close, which was April 16th, after the tariffs were announced earlier in April. And you can see year to date at that point, the S&P 500 was down 10%. The Russell 1000 growth, which think about, is just kind of supercharging the Magnificent Seven, and Magnificent Seven, I'll think about this all day, are Apple, Amazon, Alphabet, Meta, Microsoft, Nvidia, and Tesla. And those stocks, those seven darlings in the market, were down 21%. Now look at the two pools above, though. The long-term pool is only down 1.6%, and the socially responsible pool down 3.5%. And the issue here, and the reason those pools did so well, is two things. The first is they're diversified outside the US, and that included non-dollar exposure. And the second thing is we had several managers in both cases who had portfolios that just really, really preserved capital really, really well. We also have, and hopefully there'll be a few minutes at the end for me to talk about a private company that is now in the public eye a little bit, that's inside of now the core portfolio. Previously it was in the long-term pool alone. That is going to be, we think, a massive home run for the foundation, and that's not in the returns at all yet. So my point is that, really, really interesting time, very complicated time, and it's hard if you're trying to guess what will happen next. And that's the beauty of the foundation strategy, again, past, present, and future, which is that we rely on diversification, we rely on long-term thinking. And right now, the world is sort of coming to us in terms of mitigating downside, like you see here, and also when it comes to allowing us to generate huge gains, again, from buying pessimism in a time where things are tricky, to put it kindly. So I will pause there, and we'll stop sharing and hand it back to Philippe.
Thank you so much, Mike. Just to note that for those who might be experiencing a drop in quality in the video or the voice, we might encourage you to go off camera, see if we can free up a little bandwidth so we don't get those drops. Barry, I'm going to turn it over to you to talk a little bit, you and Stacy, to talk a little bit about the new core pool that we launched. For those of you on the call, as we mentioned earlier, early in July, we launched our new VCF core pool, or core investment pool, which is what we're calling it. This is a merger of our long-term, medium-term, and socially responsive pools. It is a really fascinating and wondrful thing, and I wish we had a whole hour just to talk about this, because I think it provides enormous value for our fund holders, and is a really wonderful example of thinking a little bit outside the box, something that we like to do at the VCF. So Barry, I'm going to let you and Stacy talk us through the rationale and the strategy for it, and then Mike can talk a little bit further as we get into it.
Thanks, Philippe. As Philippe mentioned, my name is Barry Pius. I'm the Vice President for Finance at VCF. VCF merged, as Philippe said, our long-term, midterm, and socially responsible investment pools to create a simpler, more mission-aligned structure that was focused on reducing fees, improving performance, and strengthening social impact. The core investment pool brings together the most value-aligned, high-performing investments from our existing pools into one focused portfolio, which we see as extremely valuable long-term. We see market investments as another way to complement our grant making and mission investment in Vermont. The change reflects our commitment to thoughtful stewardship, a strong fund holder experience, and maximize the impact of every dollar that's entrusted to us. And we take that very, very seriously. And as Philippe mentioned, this process, or this thinking, has been going on for well over a year. We were really focused on trying to improve performance. And I think Mike mentioned in his brief presentation that we're seeing that the fruits of that labor now, and we see that going forward. We see fees being lowered. And in fact, as recently as just the last month, we saw with the core pool, our fee structure go down to roughly around 44 basis points. And previous to that, with the other pools, we were somewhere, especially with the long-term pool, we were over 100 basis points. So we've immediately been able to bring back value to our fund holders and our clients. And another reason rather, that we consolidated the pools is to have greater economies of scale, the ability to have more access to top investment managers. Mike and I have talked about that a lot over the years. And by having that economies of scale, we think we can bring better value, both short-term and long-term, to our fund holders. And we can also allocate more capital to businesses where risks are appropriately priced to the markets. Meaning by having that size of an investment portfolio, we're in a far better position to take risks where it's appropriate and to avoid risks, obviously where it's not appropriate. We also have a great benefit on the liquidity side. A lot of dollars came into one pool, which is our socially responsible pool, which put some pressure on liquidity needs for the other pools. By consolidating those pools now, we're more nimble and we can take advantage of current and future investment opportunities. And finally, the ability to strengthen alignment between VCF's investment portfolio and the foundation's mission. We reflect a lot about, all the work that we do for fund holders and for Vermont. And we're always thinking about continuing to bring more value to the work that we do and to our fund holders, and being intentional about VCF's decision-making and focus of enhancing VCF's value to its clients. And as Mike mentions, we think we've done that here. We think we've been able to create one portfolio focused on performance, focused on lowering fees, creating more liquidity and economies of scale, reducing the complexity, only doing business with very high quality managers. And we think that's the right formula and the right flexibility for current and future fund holders for VCF. And I also, in closing, wanted to mention all the people that contributed to this. We've had many people involved in this process over the last 18 months. VCF's investment committee played a huge role. The board of directors of VCF contributed greatly to the decision making. Obviously, crucial partners Mike and Pete have been with us lockstep since day one. And then finally, all of the team members at VCF. It really has been a team effort from the top of the organization down to management, and we feel very confident that we've selected the right solution to make VCF and its clients successful today and in the future.
Terrific. Stacy, anything you would add?
No, thanks for that, Philippe and Barry. The only thing I would just reinforce, because I do want to give the Mike the chance in as many minutes as possible to take us through the core pool principles and strategy, is just to reinforce, there are so many people on this call who are investors in VCF and investors in other ways in Vermont. You know how complex investment management is, and one of the tremendous benefits that we have at the foundation are the layers of governance and oversight and strategy that Barry outlined in his comments. And we believe that just strengthens the product that we're able to offer our fund holders and ultimately the communities and nonprofits and organizations that we invest in. So I hope you leave this call with a sense of the incredible intention, strength, and support that you all have in the VCF team, from Crucial to the board to our incredible staff. So I'll just pause there and hand it back to you, Philippe and Mike.
Yeah, great. There's no questions. I'm going to go ahead and let Mike talk a little bit about the core principles and the strategy behind this core pool.
Perfect. Thanks again. Back again. Okay, good. So I think I'm just going to reiterate a couple things that you've heard from Philippe and Stacy and Barry, and then get into a couple more details so you get a sense of what's happening. Hopefully this will stimulate or add to any questions that you might already have. So the first thing is there are some basics, and Barry talked about lower fees, which you can see on the second point, and mentioned the 44 basis points. We have some private equity, which drives up to 57 basis points, but private equities can become a smaller and smaller part of the portfolio, so that number will converge down to the 44 over time. Fortunately, we have some actually very successful private companies in the portfolio, so they're paying their freight, but we'd also like to have the fees be lower, as Barry correctly noted. The way we get to lower fees is to combine passive and active management, and that's essentially the blend of the two pools, the two longer term pools that exist right now, which is really important. And the third thing, and this is where you get into a very complicated topic, which is ESG investing and how that works. And the foundation has partnered with us to come up with what we think or develop a way that is really productive when it comes to, first of all, generating returns. There is no negotiating on the impact point that Philippe made at the very beginning, and ESG factor analysis, ESG assessment, ESG discussions. When they're done in a certain way, and they're not usually done in this way, to be clear. So take what you think and hold off for a second till we explain what we're going to do, can actually add to return and mitigate risk. And that's something that people kind of throw that out blithely. We have a great deal of intentionality around it, which I will talk about. So just to kind of get to this point of the blend, this is a very complicated page, I apologize, but we wanted to show you kind of the before and after. So these are the strategic asset mixes of the three pools that have been merged into the core pool. And you can see, if you just look at, for example, the maroon colored lines, long-term pool was about 60% public stocks, the socially responsible pool was about 64%, and the midterm pool was about 48%. The core pool is going to be basically sort of in the top end of the middle of that group, very close to the long-term pools basic equity exposure. Public equities are very similar. Fixed income is actually a little bit higher than both other pools. And the reason that is the case is because we've eliminated the hedge fund category from all existence in these pools. So there's no more hedge funds in the portfolio. And then the private assets piece is 11% today. And that, again, will probably come down over time. But you can see that this is the mix. And it's essentially eliminate fees, i.e. hedge funds, make things a little simpler, eliminate things like special opportunities and have less categories in here, a bit less. And then also essentially stay in the middle of the two longer term pools. And that's what we end up with. And all three pools have Vermont investments in them, of course. Well, now the core pool does as well. So let's talk about the ESG piece of the equation. So first of all, the committee for Vermont Community mentioned the foundation's long-term leadership role. I'll just story. When we became advisors to the foundation all the way back in 2002. We were told about the Vermont investments, which kind of floored me because I'd never heard anyone talk about something like that all the way back then. And we also talked about intentionality around impact. And the committee, the investment committee, and the foundation's leadership and the board for decades has been talking about this. And so some of the extraordinary investment returns that you've seen here historically have come from this always being to some degree a component of the strategy. So this is not a new thing for us. What is newer, though, is that we decided to step up our game about 3 years ago. And we developed an engine, which is essentially a research effort. So here's the key point, is that a lot of times the term ESG, which is sometimes called socially responsible, which is sometimes called a lot of different things, ends up being for some people, nothing wrong with this, a values question. And values are obviously very important for investors. But institutions like the Community Foundation have values, of course, but they also have a very strong desire to generate the right investment outcomes. And to the extent that we can use ESG factors, and I'm going to define that in a second for you, to help us get to a better place, we're all in. So let me just define what we mean by ESG for a second. And for those of you who are professional investors or wanted to be at some point and got their CFA charter at some point, you will remember from your studies for those 3 exams, if you took them, that ESG is actually a risk framework. It's about looking at environmental, social, and governance risks that exist. And the key point of ESG isn't necessarily not to own things, although you can make that decision, but it's mostly to account for these risks and ensure that they are either in or not in the stock price. And sometimes there's great opportunity for companies that have a lot of promise because of their positive impact and their positive brand image. Sometimes there's a lot of savings to avoid companies that have terrible governance, terrible social behavior, and that will eventually cost them. And so there's a lot of different things that are happening in these terms. And so and again, we don't have enough time to go through all the details, but I'll show you a couple things in a minute. But the key point here is that this is a risk framework. And then what we saw crucial, because we have 100 clients and they all have different opinions about what's right or wrong in the world to some degree. So we couldn't develop a values framework that worked for everybody. Instead, we developed a quantitative tool that helps our clients understand, in this case, the investment committee, what's in the pools, or pool in this case, and and this is frankly, I love our clients. I love all of you. The fact we didn't do it for you, we developed it for us. We developed so that we would become better analysts and we'd be better at interviewing managers, finding managers, because those who tell us, I don't really think any of that stuff, should not be managing money professionally. You need to be worried about these things because they're basic fundamental risk factors that affect investors, and you can't ignore them. It's just like saying, I don't really look at the balance sheet of a company before I invest in it. I mean, that's insane. Same thing. So the key point is that what we're doing is we're thinking about these factors. We're using them to drill our managers, to find new managers. And what we're thinking about too is that when you think about not just the current state, like we're talking about here, but the future, it's really interesting. And that's where a lot of the arbitrage exists today, is companies that are on a transition to something that actually makes more sense for the future. And we think about that in context of the four things listed at the bottom, which is climate crisis, equity, governance, and avoidance of destructive controversies. And so, particularly in this era, there's a lot of things that could trip you up. And so paying more attention, which is really what we're saying here, paying a lot more attention is extremely valuable. So if you look at the details, so not to get too much into the weeds, but I will tell you, this was a 2.5-year effort at Crucial. What we did is we basically bought raw data, not scores, because the problem with scores is that somebody has a judgment they're putting on those scores, and we didn't want someone else's judgment. We wanted to see the actual details. And what we did is we married that with every holding of every manager in the Vermont Community Foundation portfolio, which, by the way, we already had that because we use that, again, back to this as a research tool. So we've always had the holdings. We've always looked at things from a risk perspective based on holdings, not on what people tell us. So this list, which is not comprehensive, I think there are 27 variables in here, but this is a subset of those variables that come in through this scoring system that we have at Crucial. So we're able to run the foundation portfolio through our system, any manager we want, and that's how we basically do this. So this is just to give you a little bit of sense that there's a lot of meat on these bones and a lot that goes into the process. And we've actually been through here, Crucial, a 3 or 4 month process of training our research analysts to be better at how they interpret this data. Because a lot of times, if you spend any time in this world, a lot of things are complicated. It's not usually things are not that binary. There's a lot of different nuance that to be considered. So I'm just going to make one more point, and I'm going to hand it back to Philippe, which is that essentially the strategy looking forward slide, which is always the same, basically, is still the same for the core pool. So we're going to continue to be long-term oriented, and we're going to always remember the time is on our side when you're a long-term investor. We just think, as Barry mentioned, we just made scale even better by combining pools. So efficiency is a word I believe Barry used. We use the word scale, and it really leads to some remarkable investors that we can include in the pool. And what we did is we took our pick from both the existing investors, investing managers, and some new ones, and some, et cetera, putting things together that way. And so essentially, though, we'll continue to use index funds and compelling managers. And since I think I have maybe a minute or two extra, I'm going to steal it right now. And I just want to talk about one quick thing, which was a holding I believe we referred to at the last call, but I wanted to kind of highlight it for you really quickly. This is an unmitigated advertisement, but if you have not seen this vehicle, this is a company called Slate Auto. You can go to their website if you want, and you can buy Slate gear if you want, but more importantly, you can reserve one of these beautiful SUV/pickup trucks. This is a mid $20,000 EV, brand new car company. It does exist. It's just starting to build its production facilities in the West. This is a U.S. company that is only on this slide because we don't usually do advertisements on these calls. It's on this slide because the Vermont Community Foundation has a significant holding in Slate Auto through a private company that we hold through our measures, the core pool. Company be an incredible home run for the foundation. So, not that if you buy or not one of these trucks, but it's a remarkable revolutionary vehicle. Go check it out on the website if you want. And we're just really excited about it. But this is the kind of investing, by the way, very positive in terms of the environment, very positive in terms of the U.S. manufacturing base, very positive in terms of consumers with an option to buy a very, very inexpensive vehicle. And it's fully customizable. So if you go take a look at the website, you'll see how cool this thing is. So my point is that this is kind of doing and merged in the core, I should say, enormous value. This allows us not to worry much about what S&P 500 does next year. We're building actual companies with actual value. And just to be clear, last thing I'll say, the foundation was on the ground in first dollar in with this manager in this company. We didn't pay someone else for this. So we actually just built the company with foundation capital and other capital, other investors.
I'm going to ask, I also just remember, I would encourage you to pop your questions into the chat as they come up for you. We will do our best to answer them as you get them to us, but also remind you that we are holding time at the end of this call, so you can ask questions of Mike and of Lawrence with respect to anything related to the Vermont pool or to the core pool that we just discussed. With that, Lawrence, why don't you take us through an update of the Vermont pool?
Good morning. Thank you. And I'll note, I didn't realize we had slate in the VCF portfolio. As soon as my wife learned about it, she signed up for, so we're also on the waiting list. It is a very cool concept. As we've discussed before, we've got the 5% that goes back to 2001. We're in a range of instruments in Vermont. We make our mission investment in close coordination with our grants and impact strategy. We are focused on the areas of improving the well-being of Vermonters across the organization. The Vermont pool is that 5%, and we characterize the Vermont portfolio includes some other assets that are VCF assets, supporting organizations, and DAFs that have mission investments in addition to their allocation to the Vermont pool. So the total has grown over time quite nicely. You'll see that it's a bit flat this year to mid-year, and I'll talk about that in a couple of minutes. We use, as I said, a range of instruments to achieve these objectives. And if you want to pull down the deck from the website, you're welcome to. And it's got a list of the different investments that we've got in this portfolio. Many of these are intermediaries, they're funds. They have a lot of diversification within them as well. So we're really doing things in all corners of the state in a lot of different ways. A strong emphasis right now on housing and exploring how VCF can play a role most effectively in addressing some of the housing issues that we're experiencing. We've seen a pretty effective response to low moderate income type housing. They're very strong subsidy programs, but it's extraordinarily expensive. We've seen construction costs be very, very high. And so the middle market, the workforce housing statewide is really the stress point that we're exploring right now with ways to help accelerate home ownership for people who are having the challenges that we haven't seen for quite a long time in this country. Recently, we've had some activity. Just like to summarize sort of some of the things that we're working on. We've been working in Plainfield, both with the co-op transition and the flood recovery, village expansion out of the floodplain. We've been active with the Paramount Theater that's doing a big regeneration project of the neighboring block. Community Capital of Vermont, we just renewed our participation there. They do very small loans to emerging businesses with a lot of technical assistance. And then three that I'll talk about in a little bit more detail. We actually had our first loss in the Vermont pool that I'm aware of. And this was Working Fields. This was a staffing agency that was serving people in substance use recovery, people recently out of incarceration, and new Americans. So a very high touch staffing model. We started working on this project in 2018 with a loan that was converted to equity in 2021. And they really had grown from a Chittenden County operation to trying to be statewide, and then they expanded into Massachusetts and New Hampshire and Maine. And the combination of headwinds and timing for that expansion really didn't work out very well. We spent a lot of time helping them think through alternatives, but they ultimately suspended operations in June of this year. We were gratified that they were able to transition all of the associates to new employment operations without any gap in employment. And we look at this and say, we always look at lessons learned, whether they were successful investments or failed investments. And financially, this is a loss, about 1% of the Vermont pool. So that's going to clip our wings a bit for this year. We target about a 2.5% gain each year. So 1% of the Vermont pool is notable within a year, but this is an investment from 2018, so spread over time, not particularly intimidating. But I think it's notable that this over time served about 2,500 people, individuals and their families and coworkers indirectly. So we could not have achieved that level of income with a sustained grant making for that amount of money. So we really look at this question of what's the goal of the Vermont pool. It's to achieve parity net of losses, expenses, and inflation over time. And we'll have these from time to time, and it's important to explore them and understand them. But I'm pretty well convinced that we wouldn't have done anything differently if we had known before the fact. It really had a remarkable impact. We do balance this portfolio with things that are sort of expected to be lower yield and things that are expected to be higher yield. And so we do have some of our real estate investments, for example, are 1% loans for a long period of time. We expect to have things in the Vermont pool that will have slightly better yields. And an example of that is Features Capital. This is an investment we made a short while ago that is investing in the medtech space. And we don't think about this in Vermont particularly, but they're located in Norwich, emerging fund managers. This is a fund one. They both are impressive individuals doing, excuse me, really neat work. And a big part of a fund manager's role is to be in network and finding opportunities that other managers aren't finding and helping the businesses that they're investing in really emerge. Dartmouth Hitchcock has done a really good job over time in tech transfer. UVM has lagged, but I would say over the last 15 years or so, UVM has really improved, and we're seeing a good number of opportunities come out of UVM. So this isn't just a financial investment. This is about the ecosystem in Vermont and what's going on here. So I won't go through the details here, but this is within our healthcare, health and impact area, because some of these businesses are working in Vermont. Their research is happening in Vermont, and that's changing the lives of individual Vermonters. You can pull this down, but there's a couple of opportunities in here, Resonant Link Medical, Aprexis, that are Vermont companies that we know directly. And so we see what these folks are doing. And so we do expect over time that this fund will provide very high yields, typical venture yields, that will help support our social impact investments. And then in the middle ground, we have the Flexible Capital Fund. The Flexible Capital Fund works in the areas of working lands and renewable energy type of spaces in Vermont. There's CDFI, so they're able to pull down some treasury funds to support our investment on a co-investment basis. And they go ahead and do something that's a little bit different as well. They use revenue-based financing. Most of these businesses are not the type of businesses that get typical venture money. They're never going to be rocket ships, but they're incremental transformation, and they're in communities in Vermont where they make a really significant difference as employers. So revenue-based financing works a little bit like a royalty payment. Well, works exactly like a royalty payment, and retires the debt over time based on the business's capacity to pay. So it's just sort of an automatic tool in that respect. Not a lot of organizations using this, and it's turning out to be something that's really helpful. You can see that a wide variety of companies in Vermont that have been in Fund 1. They're transitioning Fund 2. I think we're just moving our subscription agreement for Fund 2 through the process this week. And we'll see, I expect to see these folks continue for successfully for a number of years. Big gap if they don't. I thought this slide was really interesting from Janice's deck, talking about the capacity that's emerged in the state over the last number of years. If you looked at this slide when VCF started mission investing, it would be basically empty. You know, there's a couple of these that existed then. And it really goes to the robustness of the ecosystem that's emerged and the opportunity for the evolution of the Vermont economy, that we've got this much capacity and this kind of network. And as I look across these, we have good relationships with all of these entities, including the ones regionally, because Vermont is not just its own little economic environment. We exist in the region, and it's increasingly important that we participate across the region. So I just thought it was useful to contrast the pieces that we have, the pieces that we have in this portfolio across the spectrum, capital continuum, if you will. Think of it a bit as a barbell strategy, but it's probably more accurately described as having pieces across the capital continuum within this portfolio to address the needs in different ways, rather than just a balance between numerical equity and numerical debt to arrive at a risk balance. So with that, I think we're probably ready for questions, Philippe.
Thank you so much, Lawrence. And yes, we are going to open it up for questions in just one moment. I just want to underscore that this work that Lawrence is describing, this place-based mission investment work, so not just mission investments, but mission investments that directly benefit Vermont, the communities where many of us spend a whole lot of time in. This is not work that we're going to sort of just let rest. We are going to be leaning a lot more into this in the future. We're going to have a lot more to say about this in the coming year and a half. We have made some incredible progress. As I mentioned, the Community Foundation is a leader nationally among community foundations in this kind of work. We are seeing a whole lot of interest from our donors, from our prospects, from many in the community, pushing us to find more and more ways to offer products that allow more and more people to participate in this kind of work. The idea of community foundations using their assets to benefit the communities where they exist is something that we are going to push always right out to the outer limits. So look for a lot more information on that in the next year and a half. And with that, I would love to open it up for questions from any of you, for Lawrence, for Mike, for Barry, for anybody on our leadership team.
Hey, Philippe, this is Eric. Can I just ask a couple of questions, please?
By all means, Eric, thank you.
So just first off, on your fees, congratulations and thank you for lowering your fees down to 44 basis points. And I think you said that was maybe net of the private equity. But in terms of going forward, do you have a goal as to where you want those fees to ultimately end up, kind of like a time frame, as well as sort of a range of where you anticipate those fees ending up?
Mike, do you want to take that one? Is Mike still on the call?
Yep.
Oh, yeah, sure. And I'm sorry, I might be the internet problem here, so I apologize, guys. Yeah, so I think the goal is to keep the Barry, please, and others on the foundation jump in. But my understanding of the goal is to try to essentially we're kind of at around the goal because we're trying to use some active management and some passive management. So around that low to mid 40s is kind of where we expect to end up. We are higher today because of the private equity, and that's the future, is to get that fee closer in total to the low 40s. And I think we can go lower. We obviously always will, as long as we think we're going to get higher net returns as a result. What we don't want to do, of course, is keep lowering fees if it were to lower returns. So that's where I think we're going. And I would expect the fee to converge down to that low to mid 40s over the course of the next 3 years as the private equity portfolio gets smaller. and that will create a lot of downward pressure on the fees. Plus, we'll be active, as you can tell, in making sure that we keep the fees in this range by the way we allocate capital.
Great.
Barry, anything you want to add, or anyone else? Philippe?
No,
Philippe, I'll chime in on that as well. It's Tim Briglin. I'm one of the board members and serve on the investment committee. I think it's generally the view of the investment committee that we are going to reduce, as Mike was saying, we're going to reduce our exposure to private equity in the coming years. Private equity has the highest fees, and so as that becomes a smaller part of the portfolio, as Mike was saying, that's gonna lower the overall fee range. So, just to confirm that from the investment committee standpoint.
Thank you, Tim.
Thank you for the question, Eric. Anyone else? Other questions?
If it's okay, I had one other question too.
Yes, please, Eric.
All right, thank. And maybe this is for Mike. I think he had a slide where he was discussing sort of ESG as part of your strategy, and had a whole list. I think it was slide 11, a whole list of different metrics that you would use to sort of evaluate a potential investment's ESG risk. But it looked like a lot of those metrics were backward looking. When you think about a company wanting to evolve or looking to evolve, maybe aware that they might have some ESG risk, how do you evaluate that in terms of making an investment decision? Do you have a way to be forward-looking in that decision-making process?
Oh, excellent question. Thank you. I love that question. Yeah, really great question. So yeah, we have a way, which is to recognize what you just said, first of all, right up front, which is current state is current state. And what does the future look like? So keep in mind, since we're not picking individual securities, we're picking people, investment firms that pick securities, or using indices in some cases. What we do is we talk to the investment managers and say, hey, talk to us about this name and this risk factor. And what we're looking for, of course, is really a few things. One is, like, oh, I didn't not know that. But the better and most important part is to say to them, okay, so what's the case for holding this? Is the case that, well, that's more than reflected in the stock price, because I guess we can tolerate that answer to some degree. But more importantly, when a manager lays out the future case for us and says, this is what we think this company is doing, and that's why this is actually future state is different than current state. And we can encourage them, by the way, saying, hey, investors like the Vermont Community Foundation really love what you're doing in this regard. People like positive feedback, as you know. So those factors really drive this out. So it's systematic in the sense of identifying where companies are weak currently, but then really talking to the actual investors. And a lot of the people we work with, just to be clear, in the pool are, and I'll use this term cautiously, but I'm going to say it, activists, i.e. they don't sit back and just hope things get better in companies. They want to drive positive structural change in companies. Sometimes the word activist is used for kind of green mailing and all these awful strategies that we are not pursuing. So my point is, engaging with company management teams is deeply occurring across the foundation portfolio, so that when we raise an issue with a manager like this question you've asked leads us to, and they talk about the future, that's in part due to their assessment and their discussions and maybe influence on company management teams. So that's why this whole thing has a positive feedback kind of impact loop that's happening. And then the last thing I'll add really quickly is that we're also talking to other shareholders. So we say, hey, let's find, you can look at public filings if you want to, but we know a lot of people doing this for 30 years. So we know a lot of people. And so we're able to say, let's go find 5 other shareholders. We might even know, because we know a lot about hedge funds, might even know a short seller or two we can talk to about a name. And that kind of also buttresses this entire thing, which is about, again, impact, about returns, and also about, to your question, what are people doing to understand the future returns of a holding? And that's always the key to investing. Rearview mirrors don't do you any good in this world. You need to look ahead. And that's what this question is so fabulous at teasing out. Thank you.
Yep. Thank you. And thank you, Eric, again, for asking that question. I think at some point we might even offer. I'm looking at the team. We might even offer a side opportunity for folks just to go a little bit deeper into the strategy behind this, because it is so fascinating. It is so cool. I have to say, in my 20 years at the foundation, this is one of the more interesting pieces of work, and it really speaks to the foundation wanting to understand and do more than just sort of put a label on something. It really speaks to the foundation wanting to understand the impact that is having and might have in the future. So we may do a separate conversation with that. Charlie, you have your hand up, and then we have a question, just so I can queue it up for Lawrence and team. We have a question in the chat about whether we would ever increase the Vermont Investments Program to higher than 5%, and what it would take to do that. So we'll hold that question, and then Charlie, go ahead.
Yes, thank you, Felipe. I just want to say I feel like I've just spent 45 minutes in an alternate universe. The work that Crucial and VCF is doing within Vermont is such a diametrically opposed reality to the news we're seeing nationally and to some extent internationally. So I commend everyone involved with carrying out both the ESG and the overall policy objectives of the foundation and the investment process for sticking with their beliefs and convictions. And I just wonder, Mike, has there been any blowback experienced by VCF or Crucial in the process of carrying out this policy or set of policies and the investments? Are you seeing sort of harmful side effects or even direct oppositional impacts from what's going on in Washington with Trump and his cohorts?
Mike, before you answer, if you might turn off your video just to increase your throughput.
Yep. Thank you. Is that better? A little better, I hope.
Go
Yeah.
for it.
Okay, good. So I won't answer for the VCF and the team answer VCF, but I can answer for Crucial. Charlie, actually, surprisingly, no. Frankly, I feel like we get mostly relief that we're still asking these questions, and that people are still concerned about long-term issues around climate and equity and a variety of other factors. So no is the answer to your question so far, although we've been waiting for some negative feedback, and I'm sure we'll get some at some point, but not to date.
Bravo. That's encouraging news, but we're such a tiny state, I guess they haven't, bothered to look at us closely.
And then thank you, Charlie, and thank you, Mike. And then the question for Lawrence about increasing, and the rest of the team, about increasing potentially the Vermont pool investments to more than 5.
Yeah, and I'd say there's two different aspects of this. So when we talk about the Vermont pool and the Vermont portfolio, the Vermont pool is that 5% that's allocated across all fund holders. But we do have these other tools, and recently we have been increasing the ability to make mission investments with a mission investment fund alongside a donor advised fund. And we've got a few donors who have participated. And so we're starting to see an increase in the Vermont portfolio outside of the Vermont pool and making that option available. So I think we'll continue to see growth there. And when I mentioned the explorations around housing, considering, how would we create an instrument that people could come into directly in addition to the Vermont pool that would focus on housing, for example, we're having this impact on the Vermont economy sort of in a leading way, right? That's our goal. It isn't just to respond to problems. As Dan says, when we make a grant, we see your need. When we make an investment, we see your potential. And so we are increasing to accelerate that. I think the question of whether or not the board and the investment committee would increase the allocation of the 5%, let's let this transition to the core pool stabilize, look at the yields, the blend between the long-term pool and the Vermont pool, the difference between the long-term yield and the 2.5% that we see from the Vermont pool, that it costs about 24 basis points of what's available for grant making. So that's not terribly significant. But if you were to, increase it to 10%, you'd have to think about what are the implications for grant making. So I expect we'll largely focus on opt-in for additional resources in the Vermont investment program. But we've got a lot of future in front of us. So never to say never.
Thank you, Lawrence, and thank you, Christopher, for asking the question. It's nice to have you on the call. And with that, I think we are pretty much at time. Let me just make sure that I'm not missing any hands that are up. If I'm wrong about that, please correct me. But otherwise, Thank you for everyone for joining us today. Thank you to the staff, to the board, members of the investment committee, for answering the questions and telling us a little bit about them. If you have any questions about anything that we talked about today, please do not hesitate to reach out. You can reach Stacy and her team, which are going to be your primary points of contact for questions related to your fund and the investments associated with your fund. You can reach her at philanthropy@vermontcf.org. And otherwise, I hope you have a wonderful rest of the day. Thank you again for joining us.
Thanks, everyone.